Close your eyes. Imagine you're an accountant. You're sitting in a glass tower 40 floors above Manhattan. Everyone downstairs thinks the economy is real, but your spreadsheets tell a different story. You see fake profits, hidden debt, quiet bailouts, entire companies surviving on lies. You write a memo explaining everything, then you delete it, because exposing the truth would destroy the market, and tomorrow morning, your bonus hits the account.
Enron was treated like OpenAI and Tesla rolled into one.
Auditors, banks, analysts, regulators. Everyone knew their numbers made no sense, but the stock kept rising. The bonuses kept flowing. So nobody stopped the machine. And that's what makes Enron terrifying. Not because one man fooled the system, but because the system helped fool everyone else.
Let's say you own a lemonade stand. You think maybe someday over the next 20 years, it could make $1 million. Normal accounting says, cool. Report profits when the money actually arrives. Enron said, perfect. We'll count all 20 years of possible future profits today. This was called mark-to-market accounting. And technically, it was legal. That's the important part. Enron wasn't committing fraud alone. It had help. Lots of help. Meet Arthur Andersen, one of the big bucks accounting firms in America. Their whole job was supposedly simple. Make sure companies weren't lying.
Don't lie to me, boy.
Hand it all over.
In 2000 alone, Enron paid Arthur Andersen $52 million to check the books.
Yeah, boy.
And right there, the entire system breaks. Because if someone is paying you tens of millions of dollars, are you really going to tell them their business is fraudulent? Of course not. That would be terrible customer service. And Andersen knew there were problems, because in February 2001, internal memos raised concerns about Enron's partnerships, questions about hidden liabilities that should have triggered panic. Instead, they kept signing off. Cause the stock kept rising, the bonuses kept flowing. And in bull markets, nobody wants to be the guy ruining the party. Okay, everyone, the SEC is asking questions.
Should we cooperate?
We should follow our document retention policy.
What does that mean?
It means shred faster. The SEC started asking questions, and Andersen's lead partner, David Duncan, made a decision that would destroy the entire firm. He told employees to start shredding documents. Arthur Andersen collapsed soon after. 89 years old in the industry, 28,000 employees, gone. And somehow, the next party in this crime was way worse. Here's where it gets really American. Enron had a massive problem. It needed billions of dollars. But if investors saw too much debt, the stock collapses. And if the stock collapses, the entire circus catches fire. So now the mission is simple. Get a massive loan, without calling it a loan. Which sounds impossible, until you realize modern finance is basically competitive vocabulary.
That's when JPMorgan, Chase, and Citigroup showed up like, don't worry guys, we speak fluent loophole.
Sir, Enron needs $8 billion but can't call it a loan.
So, give them a loan, but call it something else.
Is that legal, sir?
Write it down somewhere complicated.
And if someone asks,
tell them it depends on what the definition of a deception is. Here's how the trick worked. JPMorgan creates an offshore entity called Mahonia. Because whenever finance gets weird, there's always an offshore company with a name sounding like a luxury yacht. The bank sends money to Mahonia. Mahonia sends money to Enron. Enron sends commodity contracts back. Everything circles around just enough times to look complicated, and suddenly, the debt transforms into a trade. The Senate later found the banks helped Enron hide roughly $8 billion this way. 26 separate transactions, billions in fake trading activity, hundreds of millions in fees. Because apparently, if you wrap debt in enough paperwork, it evolves into innovation, and then somehow it gets even dumber. If you want to hide debt, call a bank.
Yeah, boy.
If you want to sell a barge, call Merrill Lynch. December 1999. Enron is short on earnings before year end. They need another $12 million in profit, and they need it fast. Now normal people would cut costs, sell assets, maybe improve the business.
But Enron says, ain't no way, dog.
They looked at 3 random barges floating off Nigeria and said, I got an idea so stupid it might actually become securities fraud. And boy did it. There's no real buyer. Tiny issue. So they start doing what finance people do when reality becomes inconvenient. Rebranding.
Oi, I need me some $12 million. I'm going to give you 3 barges in Nigeria and buy 'em back in 6 months' time.
Well, what's the catch? A guaranteed 15% return. It was a risky deal. And before the Merrill Lynch Internal Committee approved this deal, a senior employee named Jim Brown listed the risks during the meeting. So we've reviewed the risks on the Nigeria barge transaction.
Yes, I've listed them all out.
Good. Foreign tax, environmental, operating.
And reputational risk. The last one, the one that says we'd be helping Enron fake their earnings.
Sure, I saw that.
Okay, so?
Approved.
Wait, what?
Approved.
But I literally wrote aid and abet.
Enron's worth $45 million in future business to us. Approved. And just to make this even more absurd, the guaranteed 15% return was intentionally kept out of the written agreement, because if they put it in writing, the transaction legally becomes debt, which means everybody involved understood exactly what they were doing. 6 months later, Enron quietly bought the barges back exactly as promised. And in 2002, Anderson partners were called up to testify about the 15% cut. They simply invoked the fifth. Did you know about the 15% cut?
I invoked the fifth.
August 2001, you work at Enron, which means, statistically speaking, you think you're smarter than everybody else. The lobby looks like the future. Energy traders screaming into phones like fighter pilots with stock options. Stock prices glowing on the walls like gospel. On the trading floor, people are shouting into headsets like they are inside a casino that sells electricity. Every week there's another meeting about some revolutionary new market Enron plans to dominate.
Brilliant. I love that idea. Another one, please?
Electricity, broadband, weather. At this point, the company would probably try trading oxygen if regulators looked distracted long enough. And then, one morning, the CEO quits. Jeffrey Skilling, the guy who talked about Enron like it was the next stage of human evolution, now standing in an elevator holding cardboard boxes. Then Vice President Sharon Watkins starts looking through the numbers, and the numbers are acting suspicious as hell. Money disappears, changes clothes, gets a fake mustache, and then shows up somewhere else in the spreadsheet.
Yeah, boy.
Are we rich? Or are we just lying with confidence? Because at this point, the profits are feeling more like movie props. Outside her office, Enron is still pretending to be immortal. Employees check their retirement accounts during lunch and grin, which is a little like buying life insurance from your grandma and calling it risk management. So she writes the letter to Kenneth Lay, the CEO, about the premium rats she smells. But Lay nods his head, we're going to look into this. And he sends lawyers from Enron to investigate Enron. Wow. Incredible. Very unbiased. October 16th. Enron announces huge losses. Traders stare at screens as stock prices plummet like a piano off a skyscraper. Employees refresh stock prices like people checking a hospital monitor, waiting for a miracle. November 8th. The accounting restatement hits. Years of profits vanish overnight. Entire sections of Enron's success disappear like somebody finally turned the lights on and exposed the set. Now the panic becomes physical. Then, December 2nd, bankruptcy. And just like that, the corporate visionaries became confused employees carrying cardboard boxes to the parking lot, while the executives responsible suddenly developed Olympic-level disappearing skills. Enron didn't collapse because one man was greedy. It collapsed because an entire system decided that looking away was more profitable than looking closer, and 20,000 people who showed up to work every day lost everything while the people who built the lie kept their careers. If you found this story as corrupt, wild, and as infuriating as we did, don't forget to like, subscribe, and turn on notifications. In the next video, we're diving into another scandal that makes Enron look like an accounting homework assignment. And how about you share this video with a friend? Because honestly, they need to know this stuff too.